Then you have the intermediate term horizon, driven by recession, recovery, and growth. Again, if you feel like a recession is coming, perhaps you want to tilt the 60-40 to 55-45, for example. Then you have the tactical horizon, 1 to 12 months. It's whatever's on CNBC. All right. And you know what tactical is because your clients call you up about what's on TV, right? All the time, coronavirus, etc. They're very focused on the tactical horizon to their own detriment. And we believe that advisors spend too much time, in fact, on this tactical horizon. When they really need to do is combining all 3 time horizon, balance it out, right? Like we do, long-term, intermediate term, and short-term to build a better portfolio for their end clients.
Thank you for tuning in to Kestra Out Loud, the Advisor podcast, where we find the voice for the independent financial advisor. Today, we have an awesome guest, Paul Ma from Fidelity. Paul, Vice President, Lead Portfolio Strategist for the Portfolio Construction Guidance Team. Incredible background. Degree from Harvard, degree from MIT, CFA. Just
wicked smart, as they say in Boston.
Wicked smart.
You guys got an accent down here.
Just awesome background. What's really neat about what Paul does and how he works with the portfolio construction guidance team is really to arm investment professionals with the tools, the know-how, the confidence in not only building model portfolios, but in how to explain those to end clients, which I think is extremely valuable. So we actually brought in John Amore. He's the Executive Vice President of Kestra Financial over the wealth management team, 14 years with a massive big bank leading wealth management teams. And so we're so glad to have John here so that we can pull all the brilliance out of Paul and what he's doing to help advisors and power advisor success, really, and what we do at Kestra. So, John, I'd love to turn it over to you. I know you got to spend some time with Paul last night.
Absolutely. Thank you, Austin. Well, it's great to be here in Arizona at our Ascend event. This is my first Ascend event, 3 months to the day almost with Kestra, and great to be here with so many of our advisors. Many of our advisors are running their own money, managing the assets for their clients, and they've been doing it for a long time. And Paul, you've managed money yourself. You're an economist and an analyst, but also you've actually managed money yourself. You've done it successfully. You've learned a lot in that process. You've helped other people manage money successfully. And you've worked with all different types of advisors. So you've seen a lot. You've seen mistakes. You've seen things that you do well. Share a little bit about your perspective about what advisors can do to be better money managers.
Well, John, thank you. It was great watching a game with you last night. So we find that advisors tend to buy whatever's working looking backward. That is a dangerous habit. Remember back in 2007, before the market crashed in 2008, real estate income trust, or REIT, was the best looking asset class looking backward with a beta of 0.3, right? That means if a market were to go down 1%, REIT was only supposed to go down 0.3%. So great. Shouldn't we load up on REIT in 2007, right?
Would be an amazing trade.
Amazing trade. Unfortunately, REIT from February 2007 to February 2009 was down about 70% looking forward. We find that our competitors like to drive advisors toward software to help them build portfolios using backward-looking metrics. Because software, by definition, can only look at past returns to use that to build your perfect portfolio. But do you want your perfect portfolio built for the last 3 years? Is that what you really want? No, you probably don't want that. You want the best portfolio looking forward for this year and beyond. But software, since future return doesn't exist yet, cannot quite do that. Do you know what the most famous disclaimer in finance is, John?
Something around what happened in the past won't happen in the future.
That's right. And you know why it's so famous, a disclaimer?
It's true.
Because it's so true, right? So we believe that advisors should rely less on backward-looking software and spend more time with investment firms that have experience in asset allocation, in manager selection, like Fidelity, in building their portfolio.
So how does that perspective inform Fidelity's approach to portfolio construction? How is it different?
Absolutely. So we're obviously very forward-looking with our multi-horizon framework. So I'm sure you hear from strategists or economists that they're feeling bullish or they're feeling bearish, right? Well, they're both right and both wrong. Depends on their time horizon. They never tell you for what time horizon they're talking about. Okay. Now, even broken clock is right twice a day. So we believe that you really have to define what horizon you're talking about. And at Fidelity, we divided time horizon into 3 time horizons. We had the very long one, strategic time horizon, 10 to 30 years. That is your 60-40 stock bonds or 80-20 stock bonds strategic allocation. Match your client's risk profile that you don't try to change too much. It is your most important horizon that people spend least amount of time talking about. Then you have the intermediate term horizon, driven by recession, recovery, and growth. Again, if you feel like a recession is coming, perhaps you want to tilt the 60-40 to 55-45, for example. Then you have the tactical horizon, 1 to 12 months. It's whatever's on CNBC. All right. And you know what tactical is because your clients call you up about what's on TV, right? All the time, coronavirus, etc. They're very focused on the tactical horizon to their own detriment. And we believe that advisors spend too much time, in fact, on this tactical horizon. When they really need to do is combining all 3 time horizon, balance it out, right? Like we do, long-term, intermediate term, and short-term to build a better portfolio for their end clients.
Paul, thank you for sharing all that. We're getting a sense of Paul, the portfolio manager. But last night, watching the Super Bowl, I got to know Paul, the person. And I think our listeners, our audience would love to get to know more about you because it's a great story. You came from Taiwan to the United States at the age of 12. You went to Harvard, studied chemistry. Clearly, you didn't think you'd end up where you are today. Tell us a little bit about your journey and how you got here and some of the fun you had along the way.
Absolutely. So I grew up in Taiwan as a little boy, and my parents and I love watching American TV shows like Dallas with big houses, etc., or the OC with its big houses. And my parents would work really hard at their business, I remember, because they want to live the American dream. That's what they want. So we were lucky enough to come here to California about age 12. And I remember traveling to Dallas one day, actually, I called my mom up and say, I'm in actual Dallas. My mom's so proud that, we're living American dream, right? And of course, from the Asian background, my mom wants me to pursue something that's very stable, like a doctor. That's why I majored in chemistry in college, right? And when I decided later on in grad school that I wanted to do something more investment related, I'm definitely going off track, become rebellious to my mom's wishes. So I'm sure she's not happy right now. Anyway.
No chance. She's proud.
That's awesome. So you were a equity manager before. You work with advisors every day. What are some of the best practice trends that you're seeing from advisors?
Absolutely. So our research has found that advisors spend 44% of their time managing clients' money in that chief investment officer role or CIO role, right? When a lot of them want to really spend more time with their clients and prospecting new clients, and helping their clients build a better financial future, taking care of the loved ones, in that to be the CEO of their client's life more than just their CIO. Mm-hmm. So the visual we use at Fidelity to capture that is the advisor value stack. It's a pyramid of offerings from financial advisors to their clients, right? And at the bottom of the pyramid is the table stakes, managing the money. And involves asset allocation, manager selection, taxes, insurance, things that clients expect their advisors to do. Interestingly, we find that the fastest growing advisory practices, however, are the ones who spend more time higher up on the pyramid on things like achieving goals for the client, bring them peace of mind and fulfillment, things that really drive value in the eyes of the clients.
So how, knowing lots of advisors and many many Kestra advisors are very planning oriented, holistic oriented. They're constantly struggling with this trade-off between managing assets and some of these other things that are really important to clients. What advice would you give to advisors on what are some things they can do to better spend less time managing assets without compromising the outcomes of those portfolios, yet still spend more time with their clients?
Yes, to spend less time on the CIO role without sacrificing the quality of that managing the money layer, right? A lot of firms, including Fidelity, offer portfolio construction services. We have Portfolio Quick Check for advisors who want a quick look at their portfolio's risk analysis, for example. For advisors who want to take a deeper dive on fixed income, we have Fixed Income Portfolio Review. And for advisors who want a more comprehensive look at their portfolio guidance looking forward, I lead a team of portfolio strategists where we help advisors. It's a team of seasoned investors. All we do is help advisors build better portfolio by looking forward using multi-horizon framework. If you're an advisor who likes to outsource entire managing the money layer, we also have model portfolios you can use. So we have found that a typical advisor portfolio has an expense ratio about 64 basis points and involves about 14 funds and ETFs from 9 fund families. And our model portfolio can drive the expense ratio down to about 40 basis point or below. And our internal research team can do the research on those 14 funds and from 9 fund family so that we believe advisors can spend more time, whether through the model portfolio or portfolio construction service, spend more time in that CEO role to help their clients plan out their legacy, deal with divorce and things like that, that emotional connection that we believe we have found that will drive more referral. In fact, 3 times more referral according to Forrester research. And clients more likely to stick with the advisor during difficult times, that kind of emotional connection, and less time on that CIO role where we can, without sacrificing the quality of that managing the money layer.
The familiar with Fidelity's platform, you have these 5 Ps. Share more about that. How the 5 Ps that for advisors who may be looking to use some of these Fidelity services.
So the 5 Ps are manager research thoughts. Is from Morningstar. They're very famous for people, process, and parents and things like that, performance, right? Mm-hmm. So we add an extra P called portfolio. So you want to see how each funds work with each other, the correlation, how the fund works together. Can a fund play good defense so that in the fixed income side, for example, so the equity fund can play better offense, so they all work together to build a championship team? Because I think a lot of times when people are so focused on individual funds, they're building together an all-star team, right? But all-star team doesn't win Super Bowl. What you really want is a championship team that's sort of complementary football, complementary equity, fixed income together to build a better portfolio. That's our extra P that we added to Morningstar as the 5 Ps.
Nice.
So.
Well, Paul, thank you so much for joining us. Really appreciate sharing your insight on model portfolio management and some of your process that Fidelity does and your PCG team works with advisors. Please subscribe to our podcast, Kestra Out Loud. We're also on YouTube, Kestra Out Loud, the Advisor Podcast, where we find the voice for the independent financial advisor.